Welcome one, welcome all to DeFi Crypto and Airdrops DeFi Masterclass with David, and here he is, Jake Call. How's it going,
Hey,
bro?
you made it.
Another day calling AT&T, you know how that goes.
Oh man, yeah, you like
Ouch.
been on hold or something?
No, I'm moving in like a week and a half and I got to get my service canceled. And I live in an apartment complex, so like I can't even get into my account or something like that. I don't know. So I can't even cancel my stupid internet.
Oh, that sucks, man.
It is
Yeah,
what it is.
it's always a challenge when you're moving, but well,
They said we're gonna mail me a one-time passcode. And they said they couldn't send it to me through email or through text. I'm like, all right.
Well, you know why they do that? They do that intentionally so that
Yep.
they can keep billing you for longer, man.
I know,
Yeah.
it's ridiculous.
It sucks. Yeah.
It sucks. So let's go. I want to go ahead and show people where to find you, good gentlemen. So this is our YouTube channel, DeFi Crypto and Airdrops. At DeFi Crypto Airdrops. And if you want to find the content that these gentlemen create, Jake Call, he is the founder of Luminary Assets, as you can see behind him. Also, Metrics Finance, which is a awesome tool that I use myself. That David is helping Jake develop. That is a
No, not really.
David's sharing some inspiration.
I didn't help any.
Exactly.
Yeah.
It's like, every time that all of us talk, David's like, "Hey, this would be cool. That would be cool," and then Jake takes his team and runs with it.
The community is helping it. We'll call it the community is
There you
providing
go.
inspiration, which is how it should be. But
Absolutely. No, Jake's always open to like input from the community, like in our Discord and stuff like that. A couple of people brought up some stuff, and he was right on it. He's great at addressing those things. So, but he has two channels that I know of. One with great DeFi content that he does on his own, and another one where he has tutorials for Metrics Finance. Then you have David over at DeFi University. If you want to check out his content, he just got his channels going, but also a link in the description of all of our episodes and on our channel if you want to find his DeFi University, where you can go through his totally free course all the way from beginner to advanced. And
Mike, can you show that? Can you show that to everyone?
Yeah, I can do that real quick.
Yeah.
And we actually have a daily show that me and David have started doing for entry-level DeFi. If you're interested, it is 9 a.m. Pacific time, noon Eastern. But let me bring up DeFi University. So this is the platform, and this is all free. The only thing that costs is if you want to pay $97 a month. Twice a day, he has an hour-long video conference with him and the community where they all share information and knowledge. And I jump on from time to time. It's great to be able to ask people about how they are going about being profitable in DeFi. So highly suggest you at least go through the free content. Even if you're not going to invest in DeFi, it's great information to understand how the new financial system is going to operate. Because if you understand this or not, it is being integrated into the traditional finance system to give it a massive upgrade as we speak. Banks, institutions, governments are all doing it. So let's go ahead and jump into this. Who wants to kick it off?
I mean, I've got a couple of things on my mind, So taking a look at markets, Mike, you mind if I share my screen just real quick so we can hop to it? Let's do this. I want to take a look first over here at TradingView. And there's a couple of markets that I want to highlight just real quick. Why don't we take a look first at gold today? So GC right here. And, I've been thinking to myself, what has happened in the past? Sometimes the past can help inform your decision-making in the present. And I've got this on a weekly, and I'm taking a look. I threw down a 200-week moving average on this chart. Now, that first big pump, and remember, this is not inflation adjusted. This is just the futures contract. So that first big move in 1979 and 1980 out of gold, that was, represented a 300% extension from the 200-week moving average. Now over here in 2011, the extension from the 200-week was only 70%. And where we are today is an extension of 110%. So I'm just thinking to myself that, there's not really a whole lot of signal from that. But if I zoom in here to a daily, what we see on the daily is the extension from the 200-day. And this might be maybe a little bit more valuable. So the first big extension, 22%. The second one, 19%. The third one, 29%. The fourth one, 33%. And where we are now, if I just go up to the current price, we're 40%. So this is the largest extension that we've seen so far during this parabolic move. Now, you guys, what goes up must come down. But here's the big
unless it goes to the moon. If it goes to the moon, it's going to keep going.
It definitely could, but you see, I don't think it'll come down if it's true that the buyers are actually demanding physical delivery now. And it's no longer a world where, hey, you can trade paper. Now it's like, hey, I want and need delivery yesterday. And if that's actually the case, then maybe we don't see this crash. And instead, what we could be seeing is a repricing where.
Well, and if you're not doing futures or trading, why would you want paper gold, Dave?
Well, if you're a bank and you like trading against retail, you probably want a lot of paper gold, right? But anyone else probably wants physical. And it seems like the demand is for physical now. So gold, massive central bank demand. Silver, it seems like silver has been repressed, I think, for decades. And it looks like that price repression may have broken. But again, like, look at that chart. Like,
it looks ridiculous. It looks so ridiculous.
I silver go.
I know, man. I know silver. And so, where is this going to go? Well, maybe to get a little bit of insight, let's take a look at copper. But the problem with the copper market is that it actually is oversupplied in the United States and severely undersupplied globally. So this is an interesting chart to me, though. It's sitting at a level of resistance. If this breaks to the upside, I think copper could have its own little mini parabola. And if we take a look at aluminum has already started to break higher. So aluminum filling this futures gap here from all the way back in 2022 and pushing higher. So, looking at the metals there, they're all going straight up. And you've got to ask yourself, is it because the demand for physical delivery is there and not going away? And that's what some of the research that I've been reading has been saying. So,
I know copper was sold out of, some of the metals, precious metals dealers, the online precious metals dealers, the actual bars, people were buying it and having it shipped to them, and they were sold out.
Right. So there are apparently these warehouses and one of them is, I guess, very, very large. The research that I produced told us that there's like one big warehouse somewhere in the United States, I don't recall where, and it's like massively oversupplied, but that everywhere else in the world is massively undersupplied. And the mines that produce copper are either not producing nearly enough or closed. So
I know refiners, I was reading yesterday that refiners are in super short supply right now. Exactly. So, basically where, pawn shops and, gold and silver dealers, precious metals dealers that, buy, like old jewelry and, things like that. It's where they send, all of it to, because they'll melt it down into crude bars, but they'll ship it to refiners to where they will actually do it properly and ensure, the purity, the, 0.9999, percent pure. But I guess that they're just swamped. They can't keep up.
Yeah. So from what I read, it looked like they were actually, basically doing it for free because they're able to sell it for so much more after they refine it and process it into a usable form. So they're just desperate for feedstock, basically. So here, why don't we talk about, the S&P and the NASDAQ just real quick, because we got some big tech earnings earlier this afternoon. So taking a look at the NASDAQ, within a stone's throw of some fresh all-time highs here. So all-time highs, just a couple of points higher. Now, we got earnings from Meta, Tesla, and Microsoft. So if we take a look at Microsoft, the underperformer, gapped down after earnings. And so that gap down, what is that? It's looking like right now a gap down of nearly 7%. So that's a pretty big gap lower out of Microsoft. We take a look at Tesla. Tesla, last I checked, gapped up slightly. So Tesla's just clinging to support here, but this is still a gap up, 2%, okay? Not nothing. You could have done quite well probably by just selling, a strangle or a straddle, selling options because it didn't move after the report. And then let's see here. The last one is Meta. Meta gapped up. So here's Meta, big gap up. And notice there's the gap fill. So if Meta continues to the upside tomorrow, probably expect there to be some type of resistance at that gap fill right there, around like 740. So Meta gapped up to the tune of almost 8%. So big move.
Better mind that gap.
Yeah, mind the gap, man. And also mind the all-time highs in the NASDAQ, because 2 out of 3 today reported and beat and gapped up. And so tomorrow we're going to get Apple. So AAPL has actually, last I checked, it was moving up into earnings, but this is a level of resistance. This is that old all-time high from back in December 2024. Now, Apple did exceed that all-time high and then put in a false breakout up here. So this is a level of resistance now. Now, Apple tomorrow, when they report, if they gap up also, beat and raise, then that probably means that we get another leg up out of the NASDAQ. Now, if we take a look at the S&P, the S&P is sitting at resistance. So, this is definitely a level of resistance, but there's a risk of a blow off top this year, I think. That's probably an underpriced risk. So, just another couple points to the upside and the S&P could break out. Now, if it breaks out above this level of resistance, then maybe could we see a 20% year? Could we see like a really big year in the face of all of this worry? I think that's a possibility. That's a real possibility. So could we see like 7,700 on the S&P or maybe 8,000 at the bare minimum? I kind of think so, unless something falls apart. And I just don't see that, because when we look at the MOVE index, a measurement of bond market volatility, we just don't see any bond market vol. And the beauty of this is that it has been the leading indicator for the last like 18 months for the S&P. So here is...
you inverted it. I was like, what the hell just happened?
Yeah, so I inverted it. And then take a look at this, you guys. So this is really interesting. If I just go ahead and grab the S&P here and throw this on top.
I was like, it went from dumping to pumping.
Look at that. Look at that. That is a perfect correlation right there. Yeah. So the S&P has just been tracking bond volatility lower. And since the Fed is now buying some crazy tens of billions of dollars.
Maybe explain that for people listening. Like, why? How does that make sense when we're basically buying our own debt?
Exactly, monetizing the spending, the deficit spending of the federal government. That's what the Fed is doing. They've become the marginal buyer, and they're also helping the Treasury to roll, because there's like some ungodly sum, like $7 trillion in treasuries that need to roll this year. So the Fed is effectively helping the Treasury to do that, and in the process, monetizing that government deficit spending here in the United States. So that liquidity has driven down bond volatility. Like, look at that. So this is the candlestick chart here. That's bond market vol inverted. So a chart going up means bond volatility going down.
Yeah.
So it's basically like, going straight down. And as that bond market vol goes straight down, the S&P tracks it straight up. So yeah, this is a really interesting correlation. Now, you got to ask yourself, where does Bitcoin and Ethereum fit into this mix, right? Like, what type of assets are Bitcoin and Ethereum, are they really risk assets, or are they some type of leading indicator? Because when I look at Bitcoin and I compare it to every other risk asset, even the supposed safe havens like gold and silver, Bitcoin kind of looks like doo-doo. Like, so.
Oh, absolutely.
So what is Bitcoin? Is it digital gold? Is it a risk on asset? Is it a barometer of something?
I like to call it an experiment in decentralization. And, at the end of the day, I'll be the first to say, when you buy Bitcoin, you are buying thin air. Like, there's nothing to back it. Sure, gold's a precious metal. And sure, the reason why people want gold is because they believe the value is going to go up. But really, the only reason why you would invest into gold is because other people want to buy gold. So it's a question of, can Bitcoin create that same exact effect just digitally? And realistically, it could. But at the same exact time, it's not treated as such quite yet, just because of how volatile it is. But again, when you start looking at gold on the upside recently, I mean, it could start to fall in line, especially with where it could head to the downside. But that's the way I like to look at gold and Bitcoin, especially.
Well, there's something to be said for, like, people in general. They love, tactile, they love to touch things. It's the same thing with like online shopping. I'm one of them. Especially if I'm clothes shopping, I want to try something on. I want to see how it feels. How it fits. Your shoes, same thing. But gold, silver, things like that. It's something. There's something to be said that for something that you can hold in your hand.
You hold it, and you use it to build other things. There's specific, as a part. But at the same time, like, are we moving to a world where that tangible aspect is less and less? I mean, think about VRs. Think about the whole metaverse bullshit we saw years ago. Like, who knows? Maybe one day that could be something. Think about digital art. Think about movies being downloaded on your computer instead of having an actual CD, DVD. Like, that's, so it's a question of, right now, people, yes, they like to touch things. And no, I wouldn't consider Bitcoin digital gold, but I think there's a day in the future where it would be considered that digital gold. And that's because, there's a set, like, exactly how much is out there of Bitcoin and how much is going to be put out there. And, over time, it becomes more valuable as more people want it. It's the question of, like, will it truly be adopted as something that everybody practically holds in their investment portfolio, I would say.
I mean, I think Mike, just sorry, David, real quick. I just wanted to say that I really think it has a lot to do with onboarding and education, because there are so many people. I'm sure that you've all seen the videos where there's somebody on the street and they're like, right now, will you take, do you want this $100 bill or would you like one Bitcoin? And almost everybody's like, I'll take the $100 bill. And he's like, you do understand that, Bitcoin is like, I think at the time it was like 60 something thousand dollars or 70 something thousand dollars, and it's just, there's very few people that understand and are knowledgeable at any level in this industry. So David, go ahead. I'm sorry.
Oh yeah. So, Mike, what we've been talking about all week and last week too, is in the DeFi high school, in those live calls, just what is money? And money seems to me to be mostly shared consensus. It's belief, right? You believe that something has value. And so you're willing to exchange goods, services, time for this thing that you believe has some type of stable value. There are other elements too, but I think Bitcoin needs more belief. I think that Bitcoin also has some problems. Like, if you really look at what Bitcoin is, like, there are definitely areas for improvement. There are only a handful of people that actually maintain the code. It's definitely possible for the mining to become centralized. It seems as though it has been. And, it needs like a real use case. There needs to be something there needs to be a way for miners to continue to earn enough revenue to keep their machines on, to justify keeping their machines on and upgrading to the next cycle of hardware. And if there's no transaction volume because this asset is viewed as digital gold, well, then why in the world would the miners, continue to invest in new machines and the electricity to mine it?
what about DeFi? I mean, what if, miners, could mine and, hold their Bitcoin and use it to, because they'd be incentivized to keep the network secure and, keep it running, if they have a vested interest, correct? So if they had, a bunch of Bitcoin and they were using it to earn yield, they would be incentivized to run those machines as, of course, as long as it's profitable. So basically, the DeFi play would have to be profitable enough to justify the overhead of running the machines.
Yeah, I just think out like a couple of halving cycles out. So if you think out two halving cycles,
but they got to figure it out, because at some point you're right.
Yeah, like what happens next cycle in just a couple of years when all of a sudden the block rewards are cut in half overnight again. And then what happens when they're cut in half again? That's a quadratic on the way down. So that is not good for miners. They need some form of revenue. Otherwise, why would you keep your machines on? I don't know, but that problem needs to be solved. And also, quantum seems like it's coming, right? So if it's true that Bitcoin is vulnerable to that, I mean, seriously, man, like
quantum is coming. It's like,
well, like it's not fun, man. It's not fun if it's true,
Oh,
So like,
no, absolutely. But
Yeah.
the thing is everybody, freaks out in crypto about it. But honestly, it's if quantum, actually becomes a thing, we got bigger things to worry about. I mean, you're talking anything that's on a computer is vulnerable to it. So, I mean, you got weapon systems, you got banks, you got institutions. It's not just crypto. So, I mean, if all of that goes down, just don't worry about your crypto. You're going to have bigger things to worry about.
I mean, but the problem is solvable, right? There are dApps right now that are working on that. It's just something to think about. But as far as protocols go, here, let me go ahead and stop this screen share. I want to see if I can share with you guys a little bit of research that I put together and share with everyone in the school group today. It's all about these DeFi protocols that generate some really great yield. But there's hidden risks to each of these. And there's one that I want to just highlight here, USD.ai. Okay, so the reason why I want to highlight this one is because it is one of the, if not the most liquid market over here on Pendle. So on Pendle, the total liquidity for this market is $215 million, and the total TVL is $500 million. So, big. This is the biggest market here. And if you take a look at the PTs over on Plasma with 49 days to maturity, we click through to that, and then you take a look at the Penco system. You can loop this up over on Euler and do 57%. And as long as the borrow utilization for the USDT in this market doesn't push a little bit higher, then you'll be able to keep that open for the next couple of weeks. What is it, 49 days, something like that? So yeah, right there, 49 days. So this looks like a really great place to park cash. However, and there's the big but here, okay? You gotta know what the hell USDAI is, right? And so I put together this research on USDAI, and it really surprised me. So do you guys know anything about this protocol? Have you looked into this?
Not a clue.
Not a clue. Jake, how about you?
I actually have an allocation, but I have not done more research other than, is it collateralized, basically? And let me tell you,
Jake just degen that shit.
Jake is just YOLO, man.
He was like, is it collateralized? Let it ride.
Hear me out. Let me explain. So first off, a couple things I look at it, like volume, liquidity, obviously, is it collateralized is the absolute first thing. But in my stablecoin side of my portfolio, I'm looking for positions, typically on Pendle, that I can hold for 3 months or so with a fixed yield. Now, I locked in a fixed yield of 15% or so off of USDAI. Now, here's the thing. When I do these, I am strategically allocating. So I might have and I allocate based on protocol, but also based on stablecoin exposure. So I consider something like USDC the lowest risk possible. So I might go and I might park a bunch of my portfolio in USDC across maybe 2 platforms or so, and get 7 to 10% on that, right? Probably 7 or 8% realistically though. And then what I'll do is I'll start to introduce a little bit to USDAI, a little bit to this other derivative of USD, this other one, this other one, this other one. And I stagger them out and I make sure that they're not linked together. Like one's not collateralized by the other, basically. That way we don't have a ripple effect. Now that works to an extent, right? There are going to be edge cases where maybe you get burned, but the overall goal is to make sure that you're getting paid enough to take the risk, and at the same time, diversifying the allocation. So if one does go bust, it's not killing your portfolio. Big example, Stream Protocol. I had five grand in Stream Protocol or so, which was like 5% of my portfolio. So again, that was a huge lesson that I learned a long time ago. I learned this with UST, where I'm like, okay, every single dollar I make in DeFi, like we're going in, we're getting 20% in Anchor Protocol. And then I rode 35 grand or so down to like 3K. But like my point is diversification. If one of these goes down, it's not going to kill me, and it's also something that I know I'm taking that risk, and I know I'm not doing the research, to the fullest extent that I could. But at the same time, it's a opportunity cost type thing.
So Jake, check it out, man. I put together all the research and I created a risk dashboard for each one of these protocols, and I rated them kind of like a bond, kind of like you would rate a bond. And so the category judged by 5 different dimensions here. And
were you able to go in there and tweak it up? I know you were saying that you had to check some things to make sure that all the numbers were accurate.
Yeah, so it's actually working.
Cool.
It's definitely working. And so this is the flight simulator. And so what I did today.
And this is on DeFiUniversity.xyz?
It is. So it's DeFiUniversity.xyz/flight. And this is totally free. It's in version 1.1. So all I wanted to be able to do here is build a portfolio of, maybe a handful of positions. I've got 7 positions on 7 protocols, 7 assets. I thought that was kind of good. 777, right? And you can see over here where I'm allocated, the niches. So I've got a single lending position on Aave. You can see that right down here. I've got, a custom spread. That's the gold hyperliquid short right there. That's a, Uniswap and hyperliquid. Over here, I've got a credit market position. So that's going to be, USDAI to a certain extent. I've got an RWA insurance position. That's RE.XYZ right here. I've got leveraged looping. That's over here on Gearbox using Save USD. That's, I think it's called Avant-Fi's product or something like that. And then yield trading. So yield trading is going to be the Pendle LP a little bit with that GAIB. That's also a credit market position. So the yield trading, I think, is neutral right here. That's neutral. Neutral.trade, which is basically an on-chain hedge fund. And so, Jake, I think you're going to like this, and you too, Mike. So this is what I'm thinking. This type of portfolio, I think I can get this up to like 20%. So I just want to be able to prove that on like a small amount, 25K, I can do 20% APY. And then wrap a actively managed portfolio like this in a token, and then just like make the token available through a front end, just like this. That would be cool.
So basically, you know what that does, though, David. You want to know what that does.
Yeah.
Now, again, don't quote me on tax advice here, but what if you can hold a token for over a year in the United States and have long-term capital gains instead of when you yield farm, you generate income, right? Because technically, as somebody that's holding the token, you have capital gains. And again, if you hold that for long enough, it's long-term compared to, if you just do it yourself in your own portfolio, you're going to end up paying ordinary income. There's no long-term ordinary income tax, unfortunately. It's just straight ordinary income at the time you receive it. And you also delay your taxes until you actually sell the token.
So Jake, one thing about the IRS rules, as an LP, what you earn as fees, that is not income.
Really?
The IRS, that's what the IRS says. But that's not the way I see it at all. Like when you LP and you earn income, even though the IRS says it's income, bro, like does the IRS say that when you sell options and receive premiums that is income? I don't think so. And that's basically what you're doing when you LP. It's just, I really hope, my point here is that I really hope that those rules Yeah, we get some better rules, man. It's a horrible rule. Yeah, I'm sorry for interrupting, but yeah.
No, completely understand. But yeah, that's one of the things, because for me, at least, I've always been told to consider it ordinary income. I would agree. I think it should be considered something else, especially when you have stuff like LVR, divergence loss, that kind of offsets that income. But at the same time, if you are paying income tax, what if you could wrap that, just like wrap staked Ethereum? Yeah, it's 4%. It's not going to make anything or save you a ton of money, but the difference in paying 20% versus, say, you're at top of the tax bracket, 38%, like that's nearly like half the taxes just by wrapping it in a token, as opposed to having it in your wallet. So
Jake, this USDAI, so there are a lot of protocols that wrap strategies in a token, and then they peg that token to one, and then they'll have another token, some type of yield-bearing token, or the yield accrues to it. That's you see that strategy, that tokenomics all over the place. But just because they pegged it to one does not make it a stable coin. Not really. I mean, kind of, sort of. It's more like you're buying shares in a hedge fund that generates cash flow, or you're buying shares in an insurance business that generates cash flow, and you just happen to be buying a token that is pegged to one. And I think because it's pegged to one, people think of these as stable coins, but like they're not. They're like wrapped strategy tokens that they just arbitrarily peg to one. Like a stable coin, in my opinion, is something like Circle or Tether, where it's backed by treasuries and cash. But these tokens, these are like strategy tokens that earn yield. So I think, I put together some research on this USDAI, put together research on every protocol that's, that I'm going to deploy into in this portfolio here. And you guys, the way that they have structured this is extremely high risk. This is not low risk. But if they win, if the bet that they made, I guess they bet the farm on like some AI company in Australia. And if they're right, then this works out really, really well. But if they're wrong, then, well, that would be bad. So, but you guys, like, it's really, really cool research. I don't know if you're interested to watch this video. I think it's like 8 minutes long. But this basically sums up what USDAI is. And this is all based on this protocol research that I did with Gemini. So that Gemini deep research, man, it is so good. And
with that yield that you were saying that you're able to earn on it, I think I could take a couple minutes and listen.
Yeah, Paul. I mean, look, 57% on plasma.
That's what I'm saying. If you can earn that on a stable coin, okay.
Yeah, but so that's the misnomer, though. So, like, when I think of a stable coin, I think of cash, and that's not what this is at all.
Oh, okay.
Yeah, not at all. Like, this is like you're like depositing into a fund that is providing like private credit to AI companies, but didn't actually do that, and now bet the farm on one company that might do that in the future. It's like you're basically a VC. Like, that's basically what you're participating in here, is like venture capital, but it's like tied to AI. You'll see what I'm talking about in the research, man. But this is not a stable coin. And like most of these markets are not stable coins. Like even Athena is like, a wrapped representation of the basis trade that they're running. They call it an algorithmic stable, but in my opinion, a stable coin is cash, and that's treasuries, and that's basically none of these. The junior tranche here, this USDAI, they say it's backed with treasuries, but we would have to verify that. So if you guys want to play this, I'd love to play this for you. I think it would be really cool.
Yeah.
Awesome. Let me know if you can hear it.
There's this new protocol, USD.AI.
Yeah, can you guys hear it? Yes, no?
That has just absolutely exploded onto the scene. We're talking over $500 million flowing into it, all based on this massive promise to bankroll the AI revolution. The pitch is that it's the perfect bridge between crypto and the AI industry's insatiable need for capital. But is it really financing the future of AI? Or is there something else entirely going on under the hood? All right, let's get into it. You have to admit, the pitch was simple and honestly pretty brilliant. Earn up to 20% yield. How? By powering the future of artificial intelligence. It's a story that just makes sense. You provide the money, they buy the GPUs that run the AI models, and you get a cut. It tapped right into the AI hype, and man, did it work. Hundreds of millions of dollars flooded in just a matter of months.
Right, very liquid.
And that right there is the big question, isn't it? It's what this whole explainer is really about.
So this is the most important thing when you're looking at any of these so-called stable coins. Where does the yield actually come from? You've got to always be asking that question.
Whenever you see a number
in all DeFi, you should be asking that question.
Yeah, but these are kind of misleading because they're all referred to as like stable coins or yield-bearing stable coins, when in reality, they're much more like just a wrapped strategy token pegged to one. Most of them.
20% APY, you've got to ask, where is the money actually coming from? Is this some revolutionary new financial engine? Or is it just a great marketing story propped up on a shaky foundation? Well, we're going to peel back all the layers and find out exactly what's going on. So, to really understand what's happening in reality, first we need to look at the design on paper, because the core idea, the theory behind it all, is genuinely clever. It all kicks off with a two-token system. The easiest way to think about it is like this. USDI is your checking account. It's a digital dollar, pegged one-to-one, that you can move around and use for stuff. It doesn't earn you anything. Then you have SUSDI. That's your savings or investment account. You put your USDI in, you get SUSDI back, and that's the token that's supposed to grow in value from all the lending the protocol does. Simple enough, right? Now, here's where the magic is supposed to happen. This is the piece that connects the digital world of crypto to the physical world of, actual stuff.
So this is actually, in my opinion, one of the coolest parts of the protocol, because they figure out a way to basically tokenize and wrap just about anything using this framework.
It's called the Caliber framework, and it's a whole new system designed to take a real-world thing, like a super expensive NVIDIA GPU, and somehow turn it into collateral that a smart contract on the blockchain can recognize. And this is how they do it. It's a pretty cool process. So an AI company takes his physical GPUs and puts them in a super secure, trusted data center. That data center then issues something called a warehouse receipt, which is a totally old school, legit legal document that just says, yep, we're holding these specific assets for this person. Then they turn that paper receipt into an NFT on the blockchain. And it's that NFT that the protocol sees and accepts as collateral to give out a loan.
Okay, so imagine instead of GPUs, you were using metal. And instead of a secure third-party data center, you had a vault. So you deposit your metal in a vault, and then that vault verifies its authenticity and issues a receipt. That receipt becomes tokenized as an NFT, and then you can use that as collateral on a DeFi protocol like Aave. So this, at a super high level, could be applied to just about anything, right? I think that's pretty cool.
No, it can be real estate. It could be anything.
Sure.
It's this wild mix of centuries-old commercial law and brand new technology. So that's the story. That's the elegant design. But now we get to the real heart of our investigation. We know the theory, but what is the actual source of that juicy 20% yield that got everyone so excited? I mean, based on everything they said, you would assume the money comes from lending to these AI companies at a high interest rate, right? They lend your money out for, say, 20, 25%, and then they pass most of that back to you. It's logical. It makes perfect sense.
That's not where it comes from.
That's not what was happening at all. When you actually look at the data and break down where the yield is coming from.
So just take a look at this for a second. Most of the yield is like a marketing mechanism from like Allo points. And then they've got like a deal with PayPal. That's, some of the yield. And then treasury bills, that's another portion of the yield. But the GPU lending, like the thing that you're kind of sold on when you swap into the token, nothing, nada.
The whole story just flips on its head. The real money from lending against GPUs, the entire point of the protocol, is practically zero, a tiny fraction of a percent. The real yield was coming from 3 other places: good old-fashioned interest on US Treasury bills, a special subsidy from a deal with PayPal, and The big one, the vast majority of the yield was just speculative allo points. I mean, this chart just lays it all out there. It's crystal clear. 70% of what people were getting was from these points, which are basically just a promise of a future airdrop. The actual core business, the GPU lending, is that tiny little sliver you can barely even see. The rest is just safe, boring T-bills and a temporary marketing promotion. So here's the bottom line. Despite all the marketing, this wasn't an AI bank. It was basically a T-bill fund that had a speculative points game layered on top of it.
Let's sink in for a second. That is just, it's really important to know that, right? But there's a saving grace here. There's a silver lining. The investment that they made, if it pays off, well, then, you all ride off into the sunset.
The gap between the story they were telling and what was actually happening was just massive. And this huge gap created a monster of a problem for the protocol. They had this enormous flood of money coming in the front door, but the plumbing to actually lend it out to AI companies, it just wasn't built yet.
Right.
Let's look at the numbers because they're pretty staggering. On the one hand, you have incredible success. Over $657 million poured into the protocol from users who wanted a piece of that 20% AI-powered yield.
What an amazing marketing campaign. Oh my goodness. Why can't I run that,
Right?
But on the other hand, a totally different picture. Less than $1.5 million was actually being used for its intended purpose, being loaned out to AI companies. All that cash was just sitting there with nowhere to go.
No bueno.
This bar chart really puts it into perspective, doesn't it? I mean, look at that. You have this absolute skyscraper of deposits, and then this tiny, almost invisible little speck representing the actual loans. This is what the auditors started calling the utilization gap. And here's the mathematical knockout punch. With a utilization rate that low, less than 0.2%, it means that even if those few loans were getting a crazy high interest rate, their contribution to the yield for that entire $657 million pool was basically nothing. A rounding error, almost completely meaningless. So the protocol was in a crisis. Its whole reason for being wasn't working, the public was starting to notice, and the clock was ticking. They had to do something big, and they had to do it fast.
Looks like a desperate.
You can really see the pressure building on this timeline. A huge launch in August. Then a little scare in November when the token briefly lost its peg, which got people nervous. By December, deposits crossed 600 million, but that's also when people started talking about this massive utilization gap. The team was cornered. They had to make a move.
Uh-oh.
And their solution was to go all in. A huge gamble.
That's not good.
They approved a single massive $500 million loan to one company,
So
an
bad.
Australian cloud provider called Sharon AI.
Oh, Sharon AI.
Their shot to close that giant gap in one single move.
No, man.
But wow, a move like this brings on a whole new universe of risk. First, you've got insane concentration risk. This single loan could make up over 3/4 of all the money people deposited. If it goes bad, it's catastrophic. Second, that whole cool legal idea of tokenizing warehouse receipts, it's never actually been tested in a court of law.
Right.
And third, the collateral itself, the GPUs, their value drops like a rock the second NVIDIA announces a new chip. So after peeling back all those layers, after looking at the story, the reality, and the huge pivot, what are we left with? What is USD.ai today, and what's the big takeaway for you? The answer really is that it's two completely different products mashed into one. On one side, you have the stablecoin, USDI, and honestly, it's pretty safe. It's just backed by boring old US T-bills. But on the other side, you have the investment token, SUSDI, and that is no longer a stable yield-bearing savings account. It has morphed into a gigantic high-risk venture capital bet on one single company and the very volatile GPU market.
Fuck. That's so stupid.
Yeah.
Why did they do
No
that?
bueno.
And look, you don't even have to take my word for it. This quote is from the conclusion of the official audit report. They spell it out in black and white. They explicitly warn people, treat the investment token not like a savings account, but like a high-risk venture capital bet. And that leaves us with the final, absolutely critical question. This project brought in hundreds of millions of dollars with a promise of safety and a steady, high yield. Now, it's doing a hard pivot into being a high-risk venture lender. Can a project like that actually succeed? And maybe more importantly, will the people who gave them money for one reason stick around for a completely different and way, way riskier ride? That's the $500 million question that remains to be answered.
So Mike, Jake, how do you guys feel about over here on Plasma using Pendle PTs and looping them up on Euler? How do you feel about this 58% now that we all know a little bit more about USDAI?
Probably wouldn't loop it, but I would still keep my allocation. I mean, nothing that I'm going to run at. I mean, but at the same time, it's because you're being compensated somewhat fairly for the risk. But it also begs the question of like, would it be better to run like a hedge strategy or something like that? So yeah.
So 12% for SUSDAI, is that enough?
I have 15, not much more, but I have 15 because I opened this a while ago, like a month ago. So I was just checking on this as well. My maturity date, which I'm also on Plasma, my maturity date is 49 days from now. So March 18th, 2026. But what I will say is this does remind me, I'm not saying it does remind me of USDR, where it was a stable.
I remember that.
Backed by real estate. Yeah, a lot of people got wrecked on USDR. A lot of people.
And didn't they also have that? It was like a DEX, like that you could use to swap in and out. There was another token on that DEX, but basically, like the real estate portfolio was too illiquid.
Yeah,
and one of the lenders pulled like $30 million in DAI overnight, basically.
Yeah,
their real estate wasn't liquid enough to fill that hole, and so the token depegged to like 60 cents, and then never came back, right?
Yeah, exactly. No,
yeah,
100%.
So,
and the thing is, it's like a good model. Don't get me wrong. It's like a stable coin backed by real estate. You make some money off it, then you over collateralize the portfolio, and that's a great model. The problem is with the illiquidity and also anything that's not backed by US dollar. I mean, think about it like with USDC. We don't have this anymore because they have really good management over at Circle. But like the assets behind USDC are somewhat illiquid as well. Not as illiquid as real estate, don't get me wrong. But they're not something that you can just like instantly pay out to somebody. You have to wind down positions, and then you have to bring that capital on chain, and then you have to pay people, or not bring it on chain, and you have to give out redemptions basically. But at the same time with USDR, I think it was just too new of a project. There's too many people worried when they couldn't get their money out, especially with a lot of moving pieces, not knowing if they can actually verify if they have the funds or not. The fact that it wasn't the US dollar backing. And yeah, I mean, I think that was ultimately what led to their downfall. So
now Jake,
personally, I'm much more risk off. If it's not a compliant stable coin that is backed, by, US dollar equivalent, gold, something, I can't. And it looks like that the yield, looks like that on Pendle, that's more of a looping strategy.
So this is actually a different token, but yes, that yield was a looping strategy. Yep.
Yeah, because I mean, there's pretty good yield on USDC and USDT out there. I mean, for me to take that kind of risk, it would have to be some pretty astronomical yield I was earning to where I could get in and in a month or two make enough money to make it worthwhile, because I just don't see it as being a long time play.
Yeah,
I hear you.
And hear me out. So the allocation that I have towards USDA right now is basically $2,000 out of my $45,000 stablecoin portfolio, or market neutral, we'll call it, because I have some hedge strategies in there as well. Right. So it's about 5%. But then the other thing to consider is like when I'm diving into these higher risk stablecoins, I kind of like think of it like this. Like a lot of the times, it's not capital coming from my bank account. I'm allocating capital from my bank to the higher quality blue chip plays. But when I have capital coming in from, say, yield positions or income from my liquidity pools or something like that, and my market exposed side of the portfolio, and I want to get into something stable, that comes from my portfolio. In other words, I'm more comfortable taking higher risk when I'm bringing money from crypto that I made in crypto into another crypto than when I'm bringing money in from my bank account that was previously in my savings. You know, there's a very different line there, because on one end, it's like income from these positions, right? Assuming it's profit income, but income from these positions, it's somewhat house money. I could play around with it. I could take a little bit higher risk, whatever. But then at the same time, income from my or money from my bank or savings account, that's money that I'm directly pulling from my quote unquote nest egg or whatever you want to call it. It doesn't make sense to dive into higher risk stuff like that, you know, unless of course that is the play.
Yeah. So the way that I think about taking that type of risk is that it's appropriate within like, you know, a broader portfolio that is, it's got to be a little bit more diversified than that. So, you know, if I'm going to take that type of risk, well, then the position size needs to be relatively small. And I need to offset that risk with other positions that are safer and, you know, build like a blended risk score. And then I've got to be able to model it. And so that's, you know, that's what I did here, right? I modeled this portfolio, gave myself a risk score. I can see my weighted average APY. I'm going to get this up to 20%. And then I want to wrap it into a token. So I think I can build something kind of like what Neutral has built. So this is so cool because, you know, this is essentially like a front end. And then you've got a handful of different strategies here, like this CTA momentum strategy. Look at the performance of this thing. You know, Sharpe ratio, not very high though. So they're taking a lot of risk to generate that yield. But what if we take a look at something like this? You know, that Sharpe ratio of 8.2, that's pretty cool. And 17% is nothing to sneeze at, you know? So I think that it could be awesome to, you know, just give this a shot and wrap it up into a token. And as long as I'm not over allocated to any one particular like wrapped strategy token, I don't even like calling them stable coins. You know, like technically they are, but I don't really like calling them that. Like if we take a look at the PTs for neutral.trade, you know, now that we know a little bit more about like how these are actually wrapped up, if this is just a wrapped version, let's see, so it's basis trades accrued. So liquid staking version of NUSD where yields are generated by Neutral from basis trades. So if this is generating yield from a JLP basis trade, or maybe from a combination of these strategies, how in the world is that a stable coin? You know, like it's just a stable coin because they arbitrarily pegged it to one. So if I'm over here on Pendle, I've got to get paid to take that type of risk to be exposed to this protocol. And if I take a look at, you know, 12.6%, I don't know, man, I don't think that really justifies the risk. So I would actually want to take a little bit of risk by borrowing against it, not like crazy leverage, but just to get the yield up a little bit more so that I can justify it. But yeah, so like 26%, I would not max loop to 26%, but maybe loop once. Or I was thinking about this, Jake and Mike. I was thinking about like the order of operations is really important. And so what do I mean by that? Well, the order in which you enter these positions and how you enter actually becomes really important, because if you're starting and all of us have limited capital, right? We're not, you know, worth tens of billions of dollars. And even that is technically limited too. So if I'm starting with a small sum of money and I want to be able to enter each of these positions, if I cheat loop in to this position and this position first, then I can actually have those on and earn a really, really nice APY. I could get it even higher without having to loop a bunch of times. So I could, so the order of operations, how you enter.
One of these other things that I like to think about now, this might be a silly thought, but it also has some logic behind it, right? A lot of the times when these stable coins crash, they crash hard, right? USDR is at 13 cents right now. UST is out of existence, right? So, you know, there's an argument to be made that when you leverage up on the yield, you're leveraging your downside, but you're not really, because it's either like all or nothing on the downside. Like you're either at $1 or you're at 10 cents. So, and if you can only lose all the money that you put in, and, you know, you're just kind of accelerating towards the downside faster, you know, again, but it depends on the strategy. If you're one of the people that can quickly get out as soon as downside happens, like sell at 85 cents, great, do that. But let me tell you, a lot of the people in here, a lot of people in general, investors, will see that at 85 cents and they'll be like, I'm going to wait. And they wait for it because they're expecting it to go back to peg. And then what ends up happening is it never ends up going back to peg. And it goes down more. And then they're at a point where they just lost all their money. So if you're one of those people, I mean, leverage might be your good friend because you're going to get compensated with more yield without you really actually taking more additional risk, you know, if you can only lose all your money. So that's going to be the case.
Check out this comment real quick. Let me know what you think about it. It says maybe make a short on a perps dex.
If there's a market for it, yeah.
Right. Yeah. So this
or if you can borrow USDAI somewhere, yeah.
Oh yeah. Oh yeah. So that would be interesting. It's just that many of these tokens are not composable all over the place. So maybe there. I know there's an Aave market for that one. I think there is. So I think it's on Plasma. Is there for USDAI? No, there is not. There is not. So it's not on. It's on Aave, and I don't think it's on mainnet. I really don't think it's on mainnet. No. So there is no Aave market. It's a bad sign. You know, Aave tends to list more conservative stuff. But you know, look, if I was going to do something like this, I would probably just say, you know, I want to generate the greatest amount of yield possible, and I want to mitigate my risk by allocating a relatively small portion of my portfolio to this. So that's what I would do here. And I would lever the thing up, and, you know, I wouldn't go after 58%, but hey, a solid 30% is awesome. I'd be happy with that.
Yeah.
For the next 49 days, sure.
Well, one of the things I want to cover real quick before we hop off today is hype. Hype has done pretty well over the past couple of days. So if you watch my channel, or maybe I've mentioned it on these lives, like I basically had an out of range hype position for like a month and a half. Like literally I entered into this position December 4th and I went out of range on December 8th, basically. And I came back in for a couple days. Point is, I was in range for about 18% of the time. And what I did is I ran an equation like, okay, how long is it going to take me to potentially recover? It could be a month or it could be 2 months. And then I ran the equation of if I rebalance right now and lock in the, at the time, like $1,500 to $2,000 of impermanent loss that I had, right? How long will it take me to make the equivalent of if I just waited? And it was longer. The better option was to wait. So I waited. It even got worse at one point in time. And then we got the rip that we needed the other day. You know, hype went up about 25%-ish. Ethereum went up a little bit, but what did that do? That created divergence. I mean, when you look at the price, not that one. When you look at hype right over here, you see this big jump. Let's look at 1 month. Big jump right over here. You see a similar jump for Ethereum, but it's much slower and it's much lower as well. Which creates, or sorry, it reverses the previous divergence that we had, putting me back in range, allowing me to rebalance at a price point that was somewhat similar to my initial entry price. So in this case, I go from having an $8,000 loss on a $24,000 position to having a $1,700 loss, and going from having a $2,500 loss versus HODL to now a $388 profit versus HODL. Now, again, don't get greedy. That was my cue to exit the position, right? And I still hold the Ethereum and I still hold the hype because those are both assets that I believe in, but I'm not holding them in the pool right now because there's so much volatility in the market. It's not really logical to hop back into a pool when we have no fucking clue what's going to happen with hype and what's going to happen with Ethereum.
I bet it sells off.
Yeah, it could very much easily sell off,
big pump.
or at least get back to a reasonable price. Now, why did hype pop the other day? Well, it's mainly because one of the companies or one of the investors that had a large allocation, I think pre-sale to hype or something like that, basically had empty or was selling, and they're basically empty with their hype. Like they basically have nothing left, meaning that they can no longer create sell pressure on them. But yeah, I now have in this instance let's see what hype we withdrew from the pool, about 487 hype that we withdrew from the pool at $34 each. That's 16,588, which you know, when I withdrew, that was still just.
You guys want me to tell you probably a big contributor to why hype?
Yeah.
So basically, Hyperliquid is partnering with Kraken. So this is actually here. I'll share this real quick.
You guys, I've got. I'm sorry, I've got to run.
Oh no, you're fine, man.
2 minutes late for my next call here, the last call of the day. But Jake, yeah, man, I'm happy that your position came back for you there.
Yeah, TLDR, profit versus hodl, and an overall profit now as well. Even though it's $1,700 loss on the pool, I'm still holding the tokens. But yeah, I'll let you hit it, David, and we'll wrap up here.
Yeah. I will definitely wrap up, but I wanted to share this because, you know, it's definitely on point with what you're talking about. But coming soon to Kraken, Hype powers Hyperliquid X, the blockchain to house all finance. Build projects, create value, and exchange assets on the same hyper-performant chain. So basically, it looks like that they might be offering DeFi on Kraken.
Interesting. I like it.
That'll be cool.
Yeah.
And then you got, I think this was.
All right, I gotta run, you guys. I'll see you guys next week.
We'll talk to you later, David.
Thanks, you guys. Thanks, Jake. See you.
So, yeah, I just wanted to share that real quick.
Yeah, no, it's definitely very interesting stuff. And, you know, again, that's part of the reason why I'm bullish on hype and why I have those positions. But mainly the lesson that I want people to understand is like patience. You got to have patience. Sometimes the most obvious answer is the simplest one, right? A lot of people want to instantly rebalance, right? Or they wait the 48 hours to rebalance, which is one of our rules. But there are exceptions where you're so fucked, you just got to wait. I mean, to be frank, like you're in such a bad position that it is better to do nothing. Like, that's the point. And always look at the math. Like, how long is it going to take you to recover by rebalancing, locking this in, getting back in the pool versus how long might it take for this to actually do something and recover over time? The good thing is these are assets I believe in. So my worst case was I was holding a bunch of hype in my wallet, which frankly, I didn't care, right? I was happy to hold a bunch of hype in my wallet. So again, like as long as you're structuring properly, you'll be fine. Have a long-term investment horizon. And yeah, don't be afraid to wait. Don't be afraid to do nothing.
and that's the key. I mean, you just hit the nail on the head is, you know, if you're getting into liquidity pools where you believe in both of the assets long-term, it doesn't hurt as much. It's not as painful to sit there and watch it out of range because, you know, you're going to have, you know, a good amount of one of those tokens, you know, depending on which side of the range it goes out of. Yeah. So, you know, it makes it a lot easier to just hold what you got if you're holding good assets as opposed to, you know, like a meme coin, you know, that you don't know if it's ever going to come back.
Exactly. That's where you're really fucked.
Exactly. Well,
awesome.
David, David's already gone, but Jake, I appreciate you, brother. As always, I've really enjoyed these shows and, you know, the kind of the topics and the content that we're able to cover for the, you know, the more advanced in DeFi. But you got any closing thoughts or?
No, that's it.
Perfect. All right. Well, then anybody that's interested later on this evening, one of the members of our community, Ellie, is going to be streaming on the arena. We're going to be playing Arc Raiders, and myself and Jay will be joining her and playing. But and then tomorrow, you know, every day on Monday through Friday, 9 a.m. Pacific, noon Eastern. Me and David are doing DeFi High, entry level DeFi. Jake, if you ever want to jump in, by all means, you're always welcome.
Of course.
And until next time, Veteran Crypto out.
Peace.